As of 11:01 a.m. Eastern Time on this Thursday, October 30th, 2025, the market is live and active, and shares of Rezolve AI PLC, trading on the NASDAQ under the ticker RZLV, are at $4.30. This is down about 0.67% for the day, or just under 3 cents from its previous close of $4.33. The stock opened lower at $4.14, hit a morning low of $4.09, and has since climbed to a high of $4.35, showing significant intraday volatility. The volume is already heavy, with nearly 3.7 million shares having changed hands, which is a considerable figure when compared to its 90-day average. Now, many investors might see that slight dip and just chalk it up to market noise, perhaps just a small-cap tech stock getting pushed around by the broader indexes. The common expectation for a company like Rezolve AI is that it's a pure high-growth story. You see AI in the name. You see headlines about analyst price target increases, some as high as $10 or $12, and you assume this is a lottery ticket. The expectation is that its AI-driven e-commerce platform is on the verge of mass adoption, and this $4 stock is just a temporary stop on its way to much higher valuations, perhaps the next NVIDIA stock. But the reality of what is happening under the hood is far more complex and tells a much different story. This isn't a simple dip. The heavy volume on a down day, following a massive 8% drop just 2 days ago, suggests a serious battle between newly arriving bulls and early investors who are taking profits or cutting losses. The reality is that Rezolve AI is a classic show-me stock. The market is no longer buying the story, it's demanding to see the numbers. The recent news of analyst upgrades is clashing directly with the reality of its financials, specifically a company with an enormous $1.4 billion market cap that, as of its last reporting, is generating trailing 12-month revenues of only around $5.3 million. That price-to-sales ratio is astronomical. This isn't just noise. It's a high-stakes debate about whether this company is the future of e-commerce or just another cash-burning machine with a great narrative. Let's really look at the recent trading action, because it's where the story is being told. That 8% drop on Tuesday, even as analysts were reiterating buy ratings, is a massive red flag. It tells you that the institutional narrative and the market's actual trading behavior are disconnected. When you see a stock trade as low as $4.48 and then close at $4.4550, as it did on Tuesday, on 8.2 million shares, that is not retail investors using the Robinhood app getting scared. That is significant block-level distribution. Someone, or some group, decided that the recent analyst optimism was the perfect opportunity to sell. This is the kind of price action that should make any self-investing enthusiast pause. The stock's 50-day moving average is up at $5.20, so we are now trading significantly below that short-term trend line, which is a bearish technical signal. What's fascinating is who is participating. Recent filings show a massive surge in institutional ownership. We're talking about an increase of over 440% in shares held by institutions in the last quarter. Big names like BlackRock, Vanguard, State Street, and even Citadel have taken positions. This is the core of the bull-bear argument. The bulls, perhaps those using Fidelity Wealth Management or running large funds, see this as the smart support getting in early. They are looking at the 89.7% per year forecasted revenue growth. They see the inclusion in the Russell 2000 and 3000 indexes, which forces index funds to buy the stock, creating a steady stream of demand. They're looking at Schwab Intelligent Portfolios or other automated systems and know that this stock is now part of the small-cap basket. This is the expectation. The big firms are in, so it must be a solid bet. But the reality is that institutional ownership is still only about 10 to 27% of the company, depending on the source, which is actually quite low. And the type of institutional buying matters. Are these long-term Fidelity mutual funds building a core position, or is it quantitative hedge funds and trading firms like Jane Street or Susquehanna, who are noted holders playing the volatility? Given the stock's wild swings from a 52-week low of $1.07 to a high of $8.45, it suggests the latter. This isn't a stable investment like Apple stock, it's a trading vehicle. For every institution buying, another might be shorting it. The put-call ratio is actually quite bullish at 0.16, meaning more call options, bets on a price increase, are being bought than puts, bets on a price decrease. This suggests that while the stock itself is selling off, the options market is still betting on a sharp rebound. This is the kind of complex setup that professional traders on the Interactive Brokers platform live for. They're looking at this disconnect and structuring trades around it. This is a very different experience from logging into your SoFi Invest account and just buying RZLV because you like the story. The data suggests a powder keg. On one hand, you have analysts at H.C. Wainwright and Roth Capital raising price targets to $10 and $12.50. On the other hand, you have financials that are, frankly, terrifying. The company's net income is a loss of over $217 million on $5.3 million in revenue. Its net profit margin is negative 4,102%. It has negative shareholder equity, meaning its liabilities exceed its assets. This is the kind of balance sheet that gives auditors nightmares. The company is burning cash, and its survival depends entirely on its ability to keep raising funds or dramatically accelerate revenue. This is the central conflict. This is a good moment to ask you, watching. Comment below what you think is a more important metric for RZLV right now, the analyst price targets or the current cash burn rate. Let me know what you're tracking. This macro environment is brutal for a company like this. We are not in a zero interest rate world. A company that is unprofitable is not pre-profitable, it's a liability until it proves otherwise. The market is not giving out free passes anymore. This is why we see this volatility. Every bit of good news, like a new partnership or an analyst upgrade, is being used as a liquidity event for someone else to get out. It's a game of musical chairs. This is why a diversified approach, using Fidelity ETFs or a managed account, is often safer. But for those who are doing their own online investing, RZLV is the ultimate high-risk, high-reward proposition. It's not a stock for your Fidelity IRA that you check once a year. It's a stock you have to watch every day on your Fidelity mobile app or whatever investing sites you use. So, what does Rezolve AI actually do to command a $1.4 billion valuation? The company provides an AI-powered e-commerce platform. The core idea is brain commerce. It's a suite of tools for online retailers that goes beyond simple keyword search. It uses its own large language model to create a more intuitive, conversational shopping experience. It aims to increase conversion rates and average order values while reducing the number of abandoned carts. It's a B2B, business-to-business, SaaS, software as a service model. They're also in the mobile commerce space, developing scan-to-buy technology. The expectation is that this technology will become essential for any retailer competing with Amazon. The business model itself is sound. The problem is execution and competition. They are fighting against giants, not just Amazon, but Shopify, Adobe, and countless other AI startups, all promising the same thing. Rezolve's path to success requires it to sign up thousands of merchants and fast. The recent financials from June 2025 showed a massive 425% increase in revenue year over year. That's the bull case right there. That's the growth. But that growth came from a tiny base, and its operating expenses grew 254% to $19.23 million, while net income was a loss of $28.93 million. This is the reality. They are spending heavily to acquire that growth. This isn't Tesla stock, which has tangible factories and a massive brand. This is a software company whose main asset is its code and its client list. The company has to prove that its customer acquisition cost is lower than the lifetime value of that customer. Right now, the market is skeptical. Looking to the future, the entire thesis for this investment rests on a few key catalysts. The bull case, the expectation, is that the company is at an inflection point. The bulls believe the recent surge in institutional interest is the smart support, recognizing that revenue is about to hockey stick. They believe the company will successfully raise more capital, as it has in the past, to fund its growth until it reaches operating profitability, which some analysts project for the first half of 2026. If they can hit their 2025 annual recurring revenue guidance and move toward the 2026 target of $500 million, this stock will not be at $4.30. It will be a multi-bagger. This is what the buyers using Robinhood stock trading or SoFi active investing are dreaming of. The bear case, the reality, is that the company is in a death spiral of dilution. The bears see the negative shareholder equity and the $217 million net loss and believe the company is uninvestable. They argue that the company will be forced to raise capital by issuing more shares, diluting current shareholders substantially. They see the 52-week range of $1.07 to $8.45 and see a broken stock, not a coiled spring. They believe the competition will eat Rezolve's lunch and that its technology is a nice